So I want you to imagine, just for a second, holding a flawlessly machined, ultra lightweight titanium landing gear component.
Okay.
Right. We're talking about a piece of engineering that is so precise, so incredibly durable, that its entire purpose in life is to keep a 400-ton Boeing 777 from, catastrophically shattering when it slams into a concrete tarmac at like 160 miles per hour.
Which is, yeah, that's no small feat.
Right. It represents basically the absolute pinnacle of human manufacturing capabilities, zero margin for error. But now, I want you to put that titanium marvel down, walk into your kitchen, and just open your cabinet.
I feel like I know where this is going, but go on.
Look at a standard, everyday, non-stick aluminum frying pan. Look at the plastic handle. What if I told you that the exact same company makes both of these things?
The wild.
And what if I told you that next week, that very same company might be building, like, the internal brains of a military stealth drone?
I mean, on paper, it sounds like a conglomerate that has completely lost its focus, right?
Yeah.
Or a business that's just trying to be everything to everyone, which, usually means they end up being exceptional at absolutely nothing.
Exactly. But that is the incredibly jarring, deeply fascinating reality of Aequs Ltd. And our mission today in this deep dive is to figure out if that apparent chaos is actually a masterclass in industrial strategy.
Which is a huge question.
It is. So we are putting on our investor hats today. The date is April 4th, 2026. Aequs just went public a few months ago, back in December of 2025.
And that IPO was massive.
An absolute frenzy. It was oversubscribed by more than 100 times. I mean, the market just devoured it. And since that listing, in just the first 3 months of 2026, they have unleashed this avalanche of news that has completely rewired the narrative of, what this company actually is.
Yeah, they really hit the ground running.
We're staring at a whole stack of sources here.
Mm-hmm.
Their IPO filings, their newly released Q3 FY26 earnings reports, some deeply skeptical but also highly optimistic analyst notes from Mangal Keshav and Finovate. And of course, the breaking news regarding these multi-billion rupee state memorandums of understanding.
Right. So for anyone who's evaluating this stock today, like if you're listening and thinking about buying in, Aequs presents a really classic, high-stakes capital expenditure story.
A CapEx story.
Exactly. This is a CapEx-heavy, infrastructure-intensive business. The sheer volume of cash required to build the kind of facilities they're operating is, it's staggering.
Say astronomical.
So if you are an investor looking for, say, a safe, predictable, quarterly dividend payout to supplement your income, you need to look elsewhere immediately.
Right. This is not that stock.
No, not at all. The analyst consensus is very clear here. Holding Aequs requires a 5 to 7 year view. You're buying into a long-term architectural shift in global manufacturing.
So our objective today is to map that architecture for you. We have to define their underlying business moat, dissect a balance sheet that is, frankly, currently bleeding cash despite massive revenue growth, evaluate the explosive new catalysts they just announced for 2026, and brutally weigh the significant risks involved.
Because there are a lot of risks.
There are. But by the end of this analysis, you should know exactly whether this high-wire act belongs in your portfolio. So before we can even touch the valuation or the financials, we really have to look at the factory floor.
Which is where the magic happens, right?
Exactly, because reading through the Mangal Keshav report, they don't talk about Aequs like a traditional part supplier. They actually talk about their manufacturing model as the product itself. The phrase they use repeatedly is ecosystems of efficiency.
Yeah, and to understand that ecosystem, we really have to look at the genesis of the company. Because Aequs wasn't born yesterday.
Yeah.
They were founded back in 2004, originally operating under the name Quest Global Manufacturing, or QGM.
Oh, QGM, okay.
Yeah, and then they went through a major rebranding to Aequs in 2014.
Mm-hmm.
But, the name change was secondary to a fundamental philosophical shift in how they believed industrial manufacturing should actually be structured.
Which brings us to the ecosystems.
Exactly.
Mm-hmm.
Today, they operate these massive, vertically integrated ecosystems, primarily anchored in India, across Belagavi, Hubali, and Koppal, and then supplemented by strategic supporting facilities in the U.S. and France.
And make no mistake, aerospace is the undisputed heavyweight champion of this operation. It's something like, 88 to 89% of their revenue comes purely from the aerospace segment?
Yes, right.
They are manufacturing over 5,000 distinct qualified parts.
Oh.
We are talking engine systems, complex landing gear components, intricate aerostructures. They hold the coveted status of a Tier 1 supplier to Boeing.
It's huge.
And with Airbus, they are a B2P award winner. Now, D2P stands for detailed to parts. And from what I understand in the aerospace hierarchy, that means Airbus hands them a raw blueprint and Aequs just hands them back a fully finished, flight-ready component.
Yeah, and achieving DDP status is essentially the holy grail for a supplier. I mean, aerospace is a heavily regulated zero-tolerance industry.
Because if a part fails, it's a catastrophe.
Exactly. Every single micromillimeter of a part is tracked, certified, and audited. The barriers to entry are just almost insurmountably high for a new player.
So how did Aequs break through?
Well, what truly sets Aequs apart is the how. They don't just machine a part. They control the end-to-end process within a single special economic zone, or SEZ.
Okay.
Their primary hub in Belagati encompasses forging, precision machining, specialized plastic molding, sheet metal stamping, highly toxic and complex surface treatments, and final assembly.
All in one place.
All in one place. And they do all of this specializing in advanced metallurgy, particularly high-end titanium alloys.
Okay, let's pause on the titanium for a second because the sources emphasize this capability heavily. Why is machining titanium such a big deal? I mean, why is it treated like this magical threshold of manufacturing competence?
Well, titanium is, it's a manufacturer's nightmare.
Really?
Oh, absolutely. It has an incredible strength-to-weight ratio, which is exactly why aerospace engineers love it. You want the plane to be light, but you want it to survive immense stress.
Sure, that makes sense.
But the very properties that make it great for flying make it terrible for cutting. Titanium has extremely low thermal conductivity.
Okay, what does that mean in a factory?
So when you cut steel or aluminum with a drill bit or a milling machine, the heat generated by the friction travels into the metal chips that fly off. The heat leaves the cutting zone.
Oh, I see.
Yeah, but titanium doesn't do that. It traps the heat right at the cutting edge. And that heat transfers directly into your really expensive cutting tool, melting it, dulling it, or just shattering it entirely.
Wow, so you're just burning through tools.
Exactly.
Yeah.
And furthermore, titanium exhibits a property called work hardening. As you cut it, the physical act of cutting makes the remaining metal harder and more brittle.
So it fights back.
It literally fights back. If your machine isn't perfectly calibrated, like if the feed rate is off by a fraction or the vibration is too high, you ruin the part and destroy your tools. Machining titanium requires massive, incredibly rigid CNC machines, specialized flood cooling systems, and operators who just truly understand the temperamental physics of the metal.
Okay, so simply having the competence to consistently machine titanium at an aerospace grade level already thins the herd of competitors down to a fraction.
Completely.
But Aequs takes it a step further with this ecosystem concept. Let's compare this to how things are normally done, because traditional manufacturing, especially in aerospace, has always seemed like a horrifically disjointed relay race to me.
A relay race is the perfect analogy. Let's trace the traditional journey of a complex aerospace component, right? You start by buying a raw titanium ingot, perhaps forged in Russia or China. That heavy raw billet is loaded onto a cargo ship and sent across the ocean to a specialized machine shop in, let's say, Ohio.
Right.
The shop in Ohio cuts the metal into the rough shape of a landing gear part. But they don't do surface treatments. So that partially finished part is packed into a crate, put on a truck, and shipped to a specialized chemical facility in Los Angeles for anodizing and anti-corrosion coating.
And then
Then is packed back up, put on another ship, and sent to an assembly plant in France where Airbus finally puts it on the airplane.
I mean, the friction in that system is mind-boggling. Every single time that piece of metal changes hands, you are burning money.
Oh, tons of it.
You are paying for shipping crates, you are paying freight costs, you are paying insurance, you are generating a massive carbon footprint by hauling heavy metal across oceans, and you're losing time.
Exactly.
If the shop in Ohio makes a mistake, the chemical plant in LA doesn't find out until 3 weeks later when they open the crate.
Precisely. You have compounding delays and compounding costs. The Aequs SEZ in Belagavie completely obliterates that entire relay race. They built a mega kitchen.
A mega kitchen, I like that.
Right. The raw titanium goes in the front gate. It is forged in one building. An electric forklift drives it 50 feet across the campus to the machining center where it's cut.
50 feet, not a cargo ship.
No, just 50 feet. Then another forklift drives it another 50 feet to the surface treatment back. Then it goes to the assembly floor. The journey of the part isn't measured in thousands of miles and weeks on cargo ships. It's measured in yards and hours.
But does this actually move the needle for someone like Airbus? I mean, does it save them enough money to care?
Oh, it fundamentally alters their unit economics. Global aerospace OEMs are desperate for supply chain efficiency right now.
Really?
Yeah, by colocating all these disparate processes, Aequs drastically reduces the lead time. And in aerospace, lead time is cash. If Airbus can get a finished landing gear in 3 months instead of 9 months, they can build planes faster and recognize revenue faster.
Okay, yeah, that's a massive advantage.
It creates what analysts call immense customer stickiness. Once an OEM integrates Aequs into their supply chain and experiences that reduction in logistical headaches and the tightening of quality-controlled loops, the switching costs become prohibitive.
Why would you ever go back?
Right. Why would Airbus ever go back to managing 5 different vendors across 3 continents when Aequs can do it all in one zip code?
And we can't ignore the geopolitical winds filling Aequs's sails right now either. The Mangal-Keshav report hammers on this Make in India initiative.
The macroeconomic timing is basically impeccable. We are living through a massive structural shift in global trade. Western OEMs are frantically executing a China Plus One strategy.
Because of the supply chain shocks recently.
Exactly. The pandemic and trade tensions expose the existential danger of relying on a single geographic region for critical components. Companies just need diversification.
Right.
And Aequs saw this coming a decade ago. They built the Belagavi ecosystem while everyone else was still relying on fragmented global networks.
So they were already waiting at the finish line.
Pretty much. Now, as aerospace giants look for a Make in India champion to anchor their Asian supply chains outside of China, Aequs is standing there with the infrastructure already built, the regulatory certifications already in hand, and the capacity ready to scale. They are the obvious answer to a multi-billion-dollar question.
Which brings us to the most confusing, whiplash-inducing part of this entire deep dive.
The pans.
The pans. If their aerospace moat is so impenetrable and the geopolitical tailwinds are practically handing them market share, why on earth are they spending their precious capital making non-stick pans and plastic toys?
We have to examine this secondary consumer segment because when I saw this in the filings, I thought I was reading the wrong company's prospectus.
It is a jarring pivot on paper. I mean, you have a facility executing sub-micron tolerances on titanium jet engine parts, and right next door, they're injecting molten plastic into molds for toy cars and pressing aluminum into frying pans.
It's absurd. It feels that way, yeah. But there is a very deliberate, calculated strategy at play here. Aequs recognized that their core competency wasn't just aerospace. Their core competency was mastering complex manufacturing at scale.
Okay.
So they began testing these waters years ago, moving into plastics in 2016 and expanding into consumer durables by 2021.
Right. The sources list a joint venture with Tramontina, the Brazilian cookware giant. So Aequs is manufacturing aluminum nonstick pans, ceramic-coated pots, tri-ply cookware, and the plastics division is pumping out outdoor toys, figurines, toy vehicles.
Yeah.
I'm sorry, but this feels like taking a Michelin star culinary team, pulling them out of their high-end kitchen and forcing them to run the fry station at a fast food drive-thru.
That's a brutal comparison, but I hear you.
I mean, aerospace is low volume, incredibly high precision, and extremely high margin. Cookware and toys are high volume, notoriously low margin, and highly commoditized. They are competing with thousands of cheap factories globally. Why risk distracting management and diluting their capital for toys?
To understand the brilliance, and yes, the risk of this strategy, we really have to look at the recent analyst notes, specifically a comparison drawn to a Chinese manufacturing behemoth called Luxshare.
Luxshare. Okay, what's their deal?
Well, aerospace, for all its high margins, is a grueling, long-cycle business. Qualifying a single new part for a Boeing jet can take 2 to 3 years of testing.
Wow, 2 to 3 years just to qualify a part?
Yes. The cash flow is incredibly lumpy. You spend millions up front, and you might not see your return for half a decade. Furthermore, aerospace is highly susceptible to massive macro shocks.
Like COVID.
Exactly like COVID. If global travel drops, airlines stop buying planes, OEMs stop building planes, and Aequs's orders dry up instantly. Consumer electronics and durables operate on a totally different rhythm. They are high volume, fast turnaround, short cycle products.
So it's a hedge. They are trying to smooth out the agonizingly slow revenue cycles of aerospace with the rapid cash flow of consumer goods.
Exactly. It's a cash flow bridge. But it's not just about making cheap toys forever. The toys and the cookware were stepping stones to prove they could handle high-volume consumer supply chains. And that brings us to the massive optionality hidden in this segment.
This is the smartwatch thing.
Yes. According to both the Finovate and Mangal-Keshav reports, Aequs recently secured a breakthrough order from what they describe as the world's largest consumer electronics brand.
Which they can't legally name.
Right, they can't name the brand. But anyone paying attention to the smartphone and laptop market can probably deduce who the major players are. Aequs has been contracted to machine and supply smartwatch enclosures and laptop parts, which will feed into this massive client's assembly facilities in Vietnam.
No, that makes sense. Making a high-end smartwatch enclosure is actually a lot closer to making an aerospace part than making a frying pan.
Precisely. Let's look at the mechanics of a high-end smartwatch. The casing is usually milled out of a solid block of aerospace-grade aluminum or stainless steel. It requires absolute flawless precision. The tolerances for the glass screen to sit perfectly flush against the metal, ensuring water resistance up to 50 meters, are microscopic.
Right, you can't have a leaky watch.
Exactly. And the surface treatment, the anodization that gives it that premium scratch-resistant color, has to be chemically perfect. Aequs is taking the exact same 5-axis CNC milling technology and surface treatment expertise they developed for Airbus, and they are shrinking it down to fit on your wrist.
And the volume difference is staggering. You might make a few hundred landing gears a year. You make tens of millions of smartwatches.
Which is the Luxshare dream. Luxshare in China started by making basic cables and simple connectors. Over a decade, they mastered high-volume, high-precision manufacturing, eventually moving up the value chain to become one of Apple's most critical final assembly partners.
And that created immense shareholder wealth.
Massive wealth. Aequs wants to replicate that trajectory in India. If they can successfully execute this initial smartwatch and laptop order, proving they can hit the quality metrics at the required volume, the consumer segment transforms overnight.
It stops being a drag.
Right? It stops being a low-margin distraction and becomes a high-velocity cash engine.
But the reality today is far less rosy. I think we need to temper the Luxshare expectations because the analysts are definitely flashing warning signs here.
Oh, for sure.
The sources explicitly note that this consumer segment currently lacks scale. The historical results for the cookware and plastics divisions have been described politely as mixed.
Mixed is a very diplomatic word.
Very. Crucially, the financial projections indicate that the consumer segment overall is highly unlikely to be profit before tax or PBT positive anywhere between FY26 and FY30.
Which means for the next 4 to 5 years, Aequs is essentially subsidizing the consumer business with the cash generated by the aerospace business or with outside capital.
Exactly. It is a total drag on their current profitability. And that provides the perfect, unavoidable pivot to the most critical part of our evaluation today. We need to open the ledger.
Let's do it.
Because the Luxshare dream and the vertically integrated aerospace mega kitchens sound incredible in theory, but they require massive, unrelenting amounts of cash to build and maintain. It's time to look at the numbers. When you dive into their financials, there is a brutal friction between their top-line revenue growth and their actual bottom-line profit.
The Aequs balance sheet is the textbook definition of a high-growth, hyper-capital-intensive industrial scaling story.
Right.
The numbers tell a story of immense ambition, but it's constrained by the physical reality of buying heavy machinery. Let's start with the capitalization event that kicked off this new era, which is the IPO in December 2025.
It was a massive capital raise. They pulled in a total of 921.81 crore. Now, we have to split that number because not all of it goes to the company.
Important distinction.
Right. There was a fresh issue of 670 crore, that is the actual cash going straight into Aequs' bank account to fund operations. The remainder was an offer for sale, or OFS, of roughly 252 crore.
And that OFS is just existing private equity investors selling their shares to the public to lock in their gains.
Exactly. But the demand for both was staggering. The retail portion was heavily oversubscribed, and the total subscription rate blew past 100 times. They listed at a 12.9% premium, trading around 140 a share out of the gate.
The market appetite was ravenous. Investors clearly bought the Make in India aerospace narrative. But as a rigorous investor, you don't just look at the stock pop. You look at the use of proceeds section in the prospectus.
What are they buying with the money?
Exactly. What exactly is management doing with that 670 crore of fresh capital? And the answer reveals the immense pressure the company's balance sheet was under.
It wasn't just for building new factories, was it?
No. The vast majority of that fresh cash, 433 crore, was earmarked immediately to clear heavy existing debt. Only about 64 crore was designated for new machinery and capex expansion, with the rest set aside for general corporate purposes and potential inorganic growth.
So they basically used a wildly successful public market debut to pay off their corporate credit cards.
That is one way to look at it, yes. And when you look at their first earnings report as a public company, the Q3 FY26 results released in January 2026, you see exactly why that debt relief is absolutely critical to their survival.
The numbers are crazy.
The top-line revenue numbers are, frankly, blockbuster. Revenue from operations for the quarter stood at 3,262 million. That is roughly 326 crore.
In a single quarter.
Yes. That represents a 51% growth year over year. It's the highest quarterly revenue in the company's history.
And the factory floor efficiency seems to be translating into the numbers, too. They reported an EBITDA of 381 million. That's up an astonishing 353% year over year, giving them an EBITDA margin of 12%.
Let's translate that for a moment because it's key. EBITDA earnings before interest, taxes, depreciation, and amortization is a proxy for the raw operational health of the business.
Right, before the accountants get to it.
Exactly. If we strip away the accounting mechanics of how they pay for their factories and how they finance their debt, the actual physical act of making titanium aerospace parts and consumer goods is generating serious, rapidly growing cash. The factories are working.
I hear that. I understand the operational health argument. But I am looking at the bottom line, and I have to raise a massive red flag.
The PAPIT.
The PAPIT, profit after tax, the actual net income that belongs to the shareholders. Despite record-breaking revenue, despite a 353% explosion in EBITDA, their Q3 PAT was negative 426 million.
Yeah.
Even if you extend them the grace of adjusting out one-time IPO expenses, the adjusted PAT is still a bleeding loss of 259 million. And this isn't a one-off blip.
No, it's a trend.
If we look back at the historical data in the prospectus, FY25 posted a heavy loss of over 1,024 million. Their historical operating cash flows have frequently been negative. So here is my deeply skeptical pushback.
Let's hear it.
88% of your revenue is from 10 massive customers. You are growing top-line revenue by 51%, and your EBITDA is soaring. Yet your net loss is actually widening.
Right.
Are investors just pouring water into a leaky bucket? At an enterprise value to EBITDA multiple of roughly 54x, the market is pricing the stock for absolute perfection. How do you justify holding a business that is growing its revenue at 50%, but still bleeding $250 million rupees a quarter?
It is the single most important question an Aequs investor must answer, and it requires a really deep understanding of the capital expenditure J-curve.
The J-curve?
Yes. You have to separate the operational health of the factories from the suffocating financial burden of having built them in the first place. Let's walk through a micro example to illustrate how this works.
Okay, walk me through it.
Let's say Aequs buys a state-of-the-art 5-axis CNC milling machine from Germany to fulfill a new Boeing contract. That machine costs 100 crore. They don't have the cash, so they borrow the euro crore from a bank at a high interest rate.
Pretty standard.
Right. Now look at the income statement. That euro crore machine doesn't hit the expenses all at once. Accounting rules require Aequs to depreciate that machine over its useful life, say, 10 years.
Okay.
So every single year, they take a 10-crore depreciation charge against their profits. It's a non-cash charge. They aren't writing a check for 10 crore, but it destroys their reported net income.
So the depreciation of the mega kitchen is eating all the profits the mega kitchen actually generates.
Exactly. When you build India's largest integrated aerospace ecosystem, you are buying hundreds of those euro crore machines. The depreciation charges hitting their income statement every quarter are colossal.
Wow.
But it gets worse. Remember the loan they took to buy the machine?
Right, the interest.
Yes. Before the IPO, Aequs was carrying over 533 crore in gross debt. A significant portion of that was likely at high interest rates, and as we'll discuss later, exposed to foreign exchange volatility. The interest payments to service that massive debt pile were siphoning off whatever actual operational cash the factories managed to generate.
It's a dual strangulation. The accounting depreciation crushes the reported profit, and the literal interest payments crush the actual cash flow.
Precisely. But here is the bull case that the market is pricing in, and why that 54x multiple exists.
Okay, what's the bull case?
The 353% jump in EBITDA proves the J-curve is starting to bend upward. The core operations are becoming profitable as they utilize more of the factory capacity. The heavy lifting of the actual building of the infrastructure is mostly complete. And crucially, the IPO fundamentally altered the capital structure. By taking that 433 crore from the public markets and immediately paying down the debt, they instantly vaporized a massive chunk of those future interest payments.
So the bleeding stops.
Exactly. In the upcoming quarters, the finance costs are going to plummet. The operational cash flow will finally start flowing down to the bottom line instead of being diverted to banks.
That makes logical sense. As revenue continues to scale over the fixed costs of the factories, the margins will expand rapidly. But we still have to be clear-eyed about the valuation. The J-curve explanation is sound, but the price of entry is steep.
Very steep.
You mentioned the 54x EBITDA multiple. The Investing Pro quantitative models, which are cited in our sources, classify Aequs's financial health as weak. The models explicitly label the stock as overvalued, suggesting a fair value target closer to 88.
Which is way below where they're trading.
Significantly below its post-IPO trading price. Investors buying Aequs in early 2026 are paying a massive premium today for profits that won't actually materialize until capacity utilization fully catches up to the colossal capex they've already deployed.
That is the crux of the gamble. The market is pricing in future execution. And Aequs management knows this. They know they cannot simply rest on their laurels, slowly waiting for airplane orders to utilize their existing factories.
Right, they need a spark.
Exactly. To justify a 54x multiple, they need massive, structural new growth engines. They need to dramatically expand their total addressable market.
Which brings us perfectly to the explosive, headline-making moves Aequs executed in February and March of 2026. This is where the story shifts gears.
Big time.
Up until now, we've talked about Aequs as a component maker. They make landing gears, they make smartwatch casings. But the catalysts they just announced signal a monumental shift toward becoming a system-level provider.
They are attempting to move up the value chain from making pieces of the puzzle to building the entire puzzle. Let's break down these state memorandums of understanding first, because the scale is breathtaking.
Yeah, in February 2026, they signed an MOU with the government of Tamil Nadu.
And the numbers attached to this are staggering. They committed an estimated initial investment of 9,900 crore, and multiple reports suggest this could scale up to a 4,000 crore investment over a 10-year period.
That is massive.
It is. They are securing land in the SIPCOT Shoolagiri Industrial Cluster. And the objective of this massive investment is to build India's first fully vertically integrated aero engine and gearbox manufacturing facility. The stated target is 100% in-country value add.
It is difficult to overstate how ambitious that target is. Machining a landing gear out of titanium is incredibly difficult, as you said. But building components for the hot section of an aero engine is an entirely different universe of complexity.
Totally different.
An aero engine is basically a controlled explosion. The internal components, the turbine blades, the combustion chambers, are operating in environments that exceed the melting point of the metals they are made from.
Which is just crazy to think about.
Right. They rely on proprietary nickel-based superalloys, single crystal casting techniques, and intricate internal cooling channels just to survive. Currently, very little vertical integration exists for aero engines in India. Most high-end engine components are imported.
So they're building a new industry from scratch, basically.
Aequs is attempting to replicate the ecosystem success they had with structural parts in Belagavi, but apply it to the most critical, highest barrier to entry part of the aircraft.
And the economics of aero engines are arguably the best business model in the entire industrial world. It's the ultimate expression of the razor and blades model.
Oh, I love this analogy. Explain that.
So General Electric or Rolls-Royce will sell the commercial aircraft engine, the razor, often at a break-even price, or sometimes even at a loss.
They lose money on the engine.
Upfront, yes. But over the 30-year lifespan of that airplane, those engines run under immense stress. Regulatory bodies mandate that internal components be completely replaced after a certain number of flight hours, regardless of how they look.
Ah, so they force you to buy parts.
Exactly. Those replacement parts are the blades. It's a captive, massive, recurring annuity for the manufacturer.
A highly lucrative annuity. Aravind Melageri, the CEO of Aequs, stated explicitly that capturing a larger share of the aero engine aftermarket is a primary strategic goal.
It makes total sense.
Right. The aftermarket for engine replacements and maintenance vastly outstrips the revenue from original equipment sales. Furthermore, because these are mandatory replacement parts, the aftermarket is remarkably resilient. Even if a recession hits and airlines stop buying new planes, they still have to fly their existing fleet, which means they still have to buy replacement engine parts.
It's recession-proof, almost.
Exactly. If Aequs can establish the Tamil Nadu facility as a trusted vertically integrated hub for engine components, it elevates their long-term margin profile and revenue stability significantly.
But they didn't stop there. Just 1 month later, in March 2026, they dropped another MOU, this time with the Karnataka government, committing another 2,856 crore over 5 years.
What's that one for?
This second MOU is fundamentally about deepening their existing moat. They are allocating funds to scale up the aerospace precision engineering ecosystem in Belagavi to handle larger, more complex aerostructure work packages.
Okay, so more of what they're already good at.
Right. And simultaneously, they are expanding the consumer electronics manufacturing hub in Hubble. It is a clear signal to the market that despite the projected near-term profitability drag of the consumer segment, management is doubling down on the Luxshare strategy. They are building the capacity to handle those massive smartwatch and laptop contracts.
Those menu are massive capital commitments. But the final catalyst from Q1 2026 might be the most strategically significant move of all, despite having the smallest price tag.
The drones.
The drones. Aequs announced a foray into military defense. They invested 10.01 crore for a 33.33% stake in a joint venture called Ajna Aerospace and Defense.
While the initial dollar amount is just a fraction of their capex budget, the technological implications are vast here. Through this joint venture, Aequs is aggressively sourcing specialized intellectual property from overseas, specifically from advanced engineering firms in Germany, Israel, and Ukraine.
Okay.
The mandate of the JV is to establish a 100% India-based manufacturing of unmanned aerial vehicles, or UAVs.
And to be clear to you listening, they aren't talking about consumer camera drones. The reports specifically tie this capability to India's rapidly expanding defense procurement strategy. They are explicitly targeting components and eventual system-level builds for the Ghatak stealth drone project.
Which is cutting edge.
It is. And they're positioning themselves as a supplier for the Advanced Medium Combat Aircraft, the AMCA India's fifth-generation fighter program. Management expects revenue from this defense JV to start materializing by FY28.
This completely rewrites the investment thesis.
It really does.
As CEO Meligeri noted in an interview following the announcement, Aequs realized they didn't just want to be a lower-tier component manufacturer on the defense side. They wanted a system-level play. Up until this moment, Aequs was primarily a commercial aviation story.
Tied to Boeing and Airbus.
Exactly. Their fortunes were inextricably tied to the commercial success and production rates of those two companies. This drone joint venture, combined with the aero engine push in Tamil Nadu, transforms Aequs into a sovereign defense and aviation independence play for India.
That's a huge pivot.
They are aligning their technological capabilities directly with national security interests and massive, insulated defense budgets.
It's incredibly visionary. You step back and look at the whole board. A company that started by forging basic parts, moved to complex titanium ecosystems, learned high-volume precision by making smartwatches and non-stick pans, and is now maneuvering to build the internal organs of India's future stealth bomber fleet.
It's like a movie script.
It is a compelling, almost cinematic industrial narrative, but...
There's always a but.
And there is always a but when you are evaluating a stock trading at 54 times EBITDA. It is very easy to get swept up in the romance of stealth drones, billion-rupee state MOUs, and the Make in India geopolitical tailwinds. The market, however, is completely devoid of romance. It is ruthless.
It really is.
We need to ground this soaring narrative by unpacking the very real, very tangible risks that are buried deep in the IPO prospectus and highlighted heavily by the analysts. Let's build the bear case.
It's absolutely crucial to do so. Aequs's hyper-growth ambitions require an investor to have a very high-risk tolerance. The first, and perhaps most glaring vulnerability staring us in the face, is extreme customer concentration.
It's bordering on a hostage situation, honestly. According to the data, a staggering 82.5% to 88.57% of their external revenue comes from just their top 10 customers.
Wow.
The vast majority of that is clustered in the aerospace sector.
That is a precarious level of concentration.
Right.
If even one of those top-tier buyers experiences financial distress, decides to pivot their supply chain strategy, or decides Aequs's pricing is no longer competitive, Aequs's top-line revenue would be decimated overnight.
Now, I'm going to push back here because I think we have to be realistic about the industry they operate in. 88% from 10 customers sounds terrifying for a software company or a consumer brand. But isn't extreme customer concentration just the inescapable physical reality of the commercial aerospace industry? There is a global duopoly. You have Airbus and you have Boeing. You physically cannot have a highly diversified client base of 1,000 different customers when there are only 2 companies on the planet building the commercial jets you make parts for.
Your point regarding the structural duopoly is entirely valid. The concentration itself isn't necessarily the fatal flaw. The fatal flaw is the structure of the legal contracts they hold with that concentrated client base.
Oh, the contracts are bad.
The risk isn't just that they only have a few customers. The risk is how those customers buy. The IPO filings clearly reveal that Aequs operates almost exclusively on what are called requirements-based or as-required orders.
Break that down for me. What does an as-required contract mean in the real world?
It means there are zero fixed long-term volume guarantees.
Oh, wow.
Yeah. When Aequs spends 3 years qualifying a new landing gear part for Airbus, Airbus does not sign a contract saying, "We legally promise to buy 10,000 of these landing gears from you every year for the next 5 years at a fixed price."
What do they sign then?
What Airbus signs is a contract that says, "We certify you as an approved supplier, we agree on a pricing matrix, and we will issue purchase orders to buy landing gears from you as we require them for our production line."
Okay, that shifts the risk dynamic completely. So let's look at recent history. Boeing has had highly publicized severe issues with the production lines, safety stand-downs, labor strikes, regulatory pauses.
Right.
If Boeing halts production of the 737 MX, they stop issuing purchase orders. Aequs is left holding the bag.
Exactly. This is the dark side of the heavy CapEx model. This is the core of the bear case. Aequs has built these massive, vertically integrated mega factories. They took on the debt. They are paying the non-cash depreciation. They are carrying the massive fixed overhead of maintaining an SEZ, paying the engineers, and powering the machinery.
They hold the risk.
They hold almost 100% of the capital risk. If Boeing stops asking for parts, Aequs cannot simply shut down the factory to save money. The fixed costs keep burning.
That's terrifying.
The leverage in this business model works beautifully on the way up when Airbus and Boeing are ramping up production and Aequs's factory utilization is high. The profits flow straight to the bottom line. But that exact same leverage is devastating on the way down.
And it's not just OEM production pauses they have to worry about. The external shocks detailed in the risks section are significant. They are heavily exposed to raw material price volatility. We spend a lot of time talking about how they specialize in titanium, aerospace-grade aluminum, and specialty steels. Aequs does not control global commodity markets. If geopolitical tensions cause the price of raw titanium sponge to spike 40%, and Aequs is locked into an as-required pricing matrix with Boeing that doesn't immediately account for material inflation, Aequs's margins simply evaporate. They have to absorb the cost.
Add to that the pervasive foreign currency risk. Aequs's operational model creates a really complex currency web. Well, they manufacture primarily in India, meaning their labor and domestic overhead costs are in Indian rupees. However, they sell globally across 22 countries, meaning the revenue is often in US dollars or euros.
Okay, that's normal for an exporter.
Right. But crucially, as of the IPO filings, nearly 39.9% of their total borrowings were denominated in foreign currency.
That was a mismatch.
It creates a severe mismatch. If the Indian rupee depreciates significantly against the US dollar, the physical cost of servicing their dollar-denominated debt artificially inflates overnight. This hit to their financials occurs totally independent of how efficiently their factories are running. It introduces a layer of macroeconomic financial volatility that is incredibly difficult and expensive to hedge completely.
The analysts also flag some contingent liabilities that investors need to be aware of, specifically about 93.43 crore in outstanding unresolved legal and tax disputes.
That's a decent chunk of change.
Now, in the context of a company generating 326 crore in a single quarter, a 93 crore potential liability isn't an existential threat. It won't bankrupt them.
No, it won't.
But for a company that is currently posting net losses and needs every single rupee of cash flow to fund its massive expansion plans in Tamil Nadu and Karnataka, an unexpected euro 93 crore cash payout to the tax authorities would certainly sting. It would eat directly into their runway.
It's a classic example of death by a thousand cuts. Any single one of these risks in isolation, a temporary Boeing slowdown, a short-term spike in titanium prices, a quarter of currency fluctuation, or a tax penalty is totally manageable for a company of this scale.
But altogether.
Right. The true risk for the investor is correlated compounding. If 2 or 3 of these external shocks hit simultaneously, while Aequs is still in this highly delicate, cash-burning scale-up phase before the consumer division and the aero engine facilities reach profitability, the financial strain on the balance sheet could become severe.
So, we have mapped the entire architecture. We've walked the floor of the mega kitchen ecosystems in Belagavi. We've unpacked the Luxshare consumer electronics wildcard and the transition from cookware to smartwatch casings.
It's been a journey.
We've dissected the bleeding balance sheet, the IPO debt payoff, and the J-curve of CapEx depreciation. We've analyzed the brilliant, visionary pivot to aero engines and sovereign defense drones, and we've stared down the very real risks of as-required contracts and extreme customer concentration.
We really covered it all.
Let's synthesize all of this. Based on everything we've uncovered, what is the ultimate profile of the investor who should be buying Aequs today?
The profile is highly specific. This stock is definitively not for dividend seekers, value investors looking for a cheap PE ratio, or anyone who is risk-averse. This is a pure growth industrial transformation story.
Okay.
It requires an investor with a high risk tolerance and a strict, unyielding 5 to 7 year time horizon. The bull case is compelling. The business moat they have built with their vertically integrated SEZs is incredibly deep and difficult to replicate.
And the revenue is there.
Right. Their top-line revenue growth of 51% proves definitively that there is massive, growing global demand for their manufacturing model. And CEO Aravind Melageri's strategic pivot toward capturing the aero engine aftermarket and integrating with India's sovereign defense drone programs is honestly nothing short of visionary.
But the bear case?
The bear case is equally stark. The valuation you are paying today at 54 times EBITDA is steep. You are paying a premium for execution that hasn't happened yet. Current profitability is deeply negative, and they are heavily unavoidably exposed to the cyclical downturns of the global aerospace duopoly and the massive capital risks of those as-required contracts.
So it all comes down to execution.
If management executes this high-wire act perfectly, if they leverage the IPO cash to permanently suppress their interest burden, successfully scale the consumer smartwatch business to profitability, and hit their ambitious targets for the Tamil Nadu aero engine facility and the Ajna drone JV Aequs, has the potential to be a generational manufacturing compounder.
And if they don't?
If they stumble in execution, the suffocating weight of their high fixed costs will drag the equity down.
It's a fascinating, terrifying tightrope walk, and I want to leave you, the listener, with a final macroeconomic puzzle to mull over. A paradox that wasn't explicitly spelled out in the analyst notes, but is deeply implied by the company's trajectory.
I love a good paradox.
We spent a lot of time talking about how Aequs is currently benefiting massively from the geopolitical China plus one strategy. Global aerospace OEMs are terrified of single points of failure. The pandemic taught them that relying on one region is catastrophic. So they are aggressively rushing to diversify their supply chains, pouring orders into places like Aequs's Belagavi ecosystem.
Makes sense.
But what happens if Aequs succeeds too well? If Aequs truly executes its vision, if it becomes the dominant, indispensable, 100% in-country value-add mega hub for all aerospace manufacturing in India, do Airbus and Boeing eventually look at Aequs a decade from now and realize a terrifying truth?
Oh, I see where you're going with this.
Do they realize they've just traded one geographic supply chain bottleneck for another? Will the OEM's endless paranoid quest for risk diversification eventually force them to actively diversify away from Aequs itself simply because Aequs became too big, too vertically integrated, and too critical to their survival?
That is a really tough question.
It's the ultimate irony of building the perfect manufacturing ecosystem. We started this deep dive talking about how investors crave clean categories, how we like companies to fit neatly into a single box on a spreadsheet. Aequs has built a box so incredibly complex, so deeply vertically integrated, and so breathtakingly ambitious that it completely defies simple categorization.
It really does.
It is a company forging titanium jet engines in one room, pressing non-stick cookware in the next, and designing the brains of stealth drones down the hall. The financial X-ray machine is definitively broken on this one. It's muddy, it's complex, it's risky, and it is undeniably one of the most compelling industrial growth stories in the market today.